Good morning, Jags. This is Fahad and Chronicle. Today is Tuesday, June 19th. How are you, Chronicle? How's it going?
Doing good this morning. How about you?
Perfect. So Chronicle has a long idea this time that he would like to pitch. This is not a short-term bullish trade. This is a vision that will continue to compound itself with growth rates for several quarters and potentially well over a year to come. The company is called Rexford Industrial Realty, symbol REXR. Very interesting, slow mover in some extent, but you get the major significant free cash flow support, steady growth on top line as well. A very easy one to go with. So, with all of that said, Chronicle, let's get started. Tell me about it.
Sure. Rexford Industrial Realty is an industrial REIT that is focused purely on industrial real estate in Southern California, which represents 100% of their portfolio. They specialize in acquiring prime property located in infill regions where it is difficult for new competition to enter, and it's also hard for new property to get built due to lack of land. If we look at the map on the right side here, we can see that there are three mountain ranges which surround the region. Meanwhile, we also have oversaturated urban development plus exorbitant land prices within the cities themselves, which makes it difficult for new warehouses to be built. So this gives Rexford pricing power when it comes to rent because it's not as if tenants have an abundance of other options here. Plus, it's not difficult to find new potential tenants to fill vacancies. And on the next slide, we can see it is precisely because of this tight supply that Rexford is well above its peers when it comes to occupancy rates and rent. Like the company has the highest occupancy rate in the nation at 98%, as well as one of the highest rent per square foot at 91 cents a month, which is 95% higher than US average. And because they are the only industrial REIT that operates locally, they also enjoy the advantage of having the deepest relationships and networks in the region, which results in the company often acquiring new property at off-market or lower prices.
Who are their biggest tenants? Just couple top names that the company is dependent upon.
So looking at various commentary from the management and as well as the 10K filings, FedEx, Command Logistics, UPS, and 32 Cold are among their top tenants. And FedEx represents 2.9% of their rent, and FedEx is their largest tenant. So portfolio-wise, it's very diversified.
Excellent. Do they also have any tech companies that depend on this? I would assume that's probably not as much because mostly, if FedEx is their biggest tenant, they're probably dependent on a lot of transportation logistics type of industrial REIT over here than some of the tech space. Or do you have any thoughts on that?
So if we go to the next slide, that's exactly the first tailwind I was going to touch on. It's that more than a third of Rexford's new leases over the past year have been e-commerce related, with the vast majority of it involved in warehousing. And the key factor here is that 100% of their entire portfolio is located within e-commerce last mile logistics. So they're pivoting towards that industry rather than tech. The urban last mile industry is becoming increasingly important as 84% of Americans are now living in cities, according to 2019 census data, and 42% of US online shoppers are expecting free 2-day delivery, according to the National Retail Federation. So it's really no surprise that companies have to increasingly rely on urban warehousing to stay competitive. Furthermore, COVID-19 has pushed consumers to try out same-day groceries and fresh food delivery, with companies like FedEx, Target, and Walmart all recently indicating they have seen positive feedback and growth in that respect. And
That's
just last, sorry.
no, that's. I was just going to touch upon this. That's fantastic because the across everywhere where we look, COVID has definitely accelerated the penetration of e-commerce trends, not only just in the United States, but really globally everywhere. And I've always said this, that once somebody is on the platform online shopping, whether it's for groceries or for anything else, it's such a sticky spot to be on that even if things basically get back to normal once this COVID situation is completely behind us, however long that may take, that new customer base that gets on the penetration side of the e-commerce, they just never revert back to doing the same thing old ways. So this basically becomes a sticky point from customers, as well as this last mileage thought with such a large population in the United States living in urban areas. Moving on to your tailwind number two. Now, I saw this article from you, and by the way, folks, the entire article as well as all of these slides will be presented on Jaguar Media, where you can download and read all your read at your own comfort time. Regarding your tailwind 2A, there's a beautiful chart here talking about how the lease expirations are going to be stacking up for the remainder of 2020 and 2021. Do you have any concerns about this? And if no, why not?
Actually, I'm seeing this as an opportunity. So as this graph shows, 28.5% of Rexford's leases are going to be expiring this year and next. And according to management, a significant portion of those expiring leases were signed prior to the e-commerce acceleration witnessed over the last 18 months, which has resulted in rent payments being only 30% higher versus the 2007 peak versus market average of 45%. So basically, those leases are currently 15% below market average rent. And going forward, this means a releasing spread of anywhere between 0 to 11.5% would be fair game, representing organic growth here. So I don't think occupancy and retention rates will drop even if Rexford increases its rent, precisely because of the tight supply dynamics we just talked about.
That's awesome. You get the boost not only from higher rental income using the same lease space, and 15% differential just seems very wide compared to market average, especially at a time when you've got these tenants that are very well situated and are benefiting from the e-commerce trends and rising volumes and such. So that's very interesting thought. Moving on to the tailwind number 2B. Tell me about this US and China spat and how does that play into Rexford?
Sure. So this is the other part of the second tailwind, which is Mexico. Specifically, I think the ongoing spat is going to result in companies sourcing more supplies from Mexico, which currently enjoys close proximity with Southern California. According to the February 2020 survey of international trade and trends in Mexico, two-thirds of respondents said that they have moved or plan to move or have considered moving some operations to Mexico as a result of trade tensions. And this is not just conjecture here because Rexford's CEO himself has said back in February that the company is seeing increased demand already from relocations.
Yeah, that's great. And this is consistent with the view that we have discussed multiple times already in the chat room and webinars recently as well with clients, where just a high level quick thought over here. I believe that doesn't matter who is the president, who is in power, but I think there's a new acceptance phase that is emerging within the big hawks in the country, both politically and the corporate culture, uh, that we need to fortify a balance sheet previously, and now we need to fortify our supply chains to reduce the reliance on China, because this COVID-19 has shown all kinds of vulnerabilities that we have in the supply chain. And I think that's a process that's going to continue to play out over the course of next several quarters. Basically, if the past 10 years were all about maximizing efficiencies in the system, which means higher margin but a weak balance sheet, and weak supply chain. The next 10 years could be all about fortifying the supply chain, as a result becoming more resilient rather than being more efficient. And if that's the major mega theme that's going to emerge, that's very, very positive for Rexford Realty. Interesting thoughts on this one. um, on the tailwind number three, smart sharpshooter acquisitions. I thought this one was very interesting, because one of the things that I always like to look at when I'm looking at a stock for a long-term opportunity is, if a company has high free cash flow, very stable, very strong balance sheet, and a very stable income statement, but no top line growth, it basically becomes an annuity. And as a result, over time, boredom starts to fall on investors if there's no top line growth. And as a result, it becomes like a utility where lower multiple continues to get assigned on the stock. So I hope that's not the case over here, because clearly you talk about the company has been pretty active in the M&A front, and they continue to also build out platforms. So tell me about this.
So Rexford has already made over a dozen acquisitions so far this year, and they are great examples of how Rexford makes use of its deep local connections. Like if we can see that they go for off-market acquisitions, and they also tend to go for properties with below market rents that are near expiry. So I'm not going to touch too much into detail with regards to specific acquisitions, but they're all detailed in the attached research note. But you can see all of this brings the total to $240.5 million in terms of acquisitions this year. And the company currently has 175 million of new investments under uh, LOI or contract. Like those numbers are pretty decent considering the economic environment we've had to deal with in April and May. I think you'd have a hard time naming other REITs that have made as many acquisitions over the last couple months.
Yeah, that's pretty impressive. More than a dozen acquisitions this year already. I mean, this is only May so far, so the company is clearly very, very active. So, but that leads me to the next question I have. Leverage on the balance sheet. If the company is the company really levering up the balance sheet to do this acquisition, because that may not be the risk right now. In fact, that may be the opportunity, given where the interest rates are and where the e-commerce trends are accelerating in the market. But long term, that could become a major problem, especially if there is a oversupply and these rents start to come down, or the churn rate or the cancellations start to begin. Are you concerned about the over leverage in the balance sheet, or you think it's actually very reasonable despite doing all these acquisitions?
Not at all. I think the company has a pretty strong balance sheet. It used to have a bit of a debt to EBITDA problem several years ago, where it was over 6, but now they've steadily gotten it down to just above 3.
Good stuff. Good stuff. Now that's very reasonable. Okay, now your final slide is taking a look at the technicals on the chart. One thing is that you're making this very, very clear to anybody listening to this, that this is a long-term investment. This is not a trade for short term. You want to own this thing for long term. Well, with that said, looking at your charts, you think that anywhere between 37.50 and 43 is where the stock should be accumulated, and then eventually you're looking for a breakout through 43 and a move all the way up to mid 50s.
Yep. So for nearly 2 years, price has been consolidating between $27 and to 32. And when the stock recently revisited the range it used to accumulate at during the March crash, whoever was previously accumulating at those prices likely stepped in again to immediately defend their position. And currently, it looks like there's another consolidation taking place. I don't know when the next breakout will happen. We need to wait for a catalyst for that. But personally, I'm treating this as a long-term investment, so a 2+ year horizon. Thus, the strategy here is to buy shares now while they're still consolidating. And once a breakout occurs, I'll look into trailing stops while adding to position on future pullbacks with no hard targets.
So continue to accumulate positions down to 40 or in high 30s, and this box will eventually break out and get into 50s. You mentioned that you don't know how long this particular phase of consolidation will last. I will just say this, that in one of our discussions in the past, I mentioned that the e-commerce penetration in the United States was increasing by 1 percentage point on an annual basis, and that was the trend for last 10 years. And so before COVID happened, as of February, only 12% of the entire retail sales in the country was happening on the internet. But in so it was 1% per year. But just since COVID, in the last 3 months, the penetration has jumped from 12% to 27% in the country. So there is a real legit argument to be made. And if this becomes especially a sticky customer base that continues to change their lifestyle to do more and more online shopping, even after COVID is over, I don't think that this particular phase of consolidation in the chart is going to be any longer than the one that we saw back in 2017 and 2018 period. I don't think this will take more than 2 years. I think you may be out of this range actually rather very quickly. Just my high level view over here. Great, fantastic presentation. And this is, once again, just to reiterate, this is a long-term idea. You want to let this trend continue to play out in your favor and continue to accumulate positions in the high 30s or around $40 per share, and ultimately look for more and more upside over the long run. I think those $53, $54 per share will be eventually revisited again by the stock in time. Thank you, Chronicle, for doing this. Fantastic presentation, and I will see you soon.